What is the difference between risk-neutral and real-world probability? Have you ever wondered how traders predict the future of stocks and options? The answer lies in understanding different types of probabilities. Today, we will discuss the difference between risk-neutral probability and real-world probability, especially in options trading. Let's start with risk-neutral probability. This concept is primarily used for pricing derivatives like options. Imagine a world where investors do not care about risk. In this scenario, everyone expects the same return, which is the risk-free rate. This rate is similar to what you would earn from a government bond. Because of this assumption, traders can price options without worrying about individual risk preferences. The prices derived from risk-neutral probabilities ensure that there are no opportunities to make a risk-free profit by taking advantage of price differences. Now, let's contrast that with real-world probability. This type of probability reflects how events are likely to unfold in actual markets. In the real world, investors are generally risk-averse. They expect higher returns for taking on more risk. For instance, stocks tend to grow faster than risk-free assets because investors want compensation for the uncertainty they face. Real-world probabilities help forecast where a stock price might be in the future or how long it might take to reach a specific target. In options trading, these probabilities are used differently. When you use models like the Black-Scholes model or a binomial tree to price an option, you are applying risk-neutral probabilities. These models do not predict whether the stock will go up or down. Instead, they ensure that the option's price aligns with other market prices, eliminating arbitrage opportunities. The expected return of the stock in this case is the risk-free rate, not its true expected return. On the other hand, if you are running a Monte Carlo simulation to estimate how often a stock might hit a certain price target, you would use real-world probabilities. This method models the stock's growth at its expected real-world rate, which includes a risk premium. This approach gives you a clearer picture of how the stock might behave over time, rather than just how it is priced today. The practical difference between these two types of probabilities becomes clear in projections. Risk-neutral scenarios often show lower future stock prices because they discount future cash flows at the risk-free rate. In contrast, real-world scenarios, which use a higher discount rate that includes a risk premium, project higher future prices. For example, if you want to value a call option using risk-neutral probability, you would assume the stock grows at the risk-free rate. This reflects the cost of hedging the option perfectly. However, if you used real-world probability, you would assume the stock grows at its expected return, which is higher. This method is not as helpful for pricing the option according to the market. But if you want to estimate how often the option will be in the money by expiration, real-world probability gives you a more realistic view. In summary, risk-neutral probability is a pricing tool for derivatives, ensuring no arbitrage and matching market prices today. Real-world probability serves as a forecasting tool, reflecting actual market expectations and risk preferences. Both are essential in options trading, but they have different roles, one for valuation and the other for projection and risk assessment. Understanding when to use each type is key for anyone involved in trading stocks and options.